Hey there, and welcome to Real Investment News. I'm Mike O'Neill. Investors are holding their breath this morning, waiting to hear the Fed's decision on interest rates. We are expecting them to go up today. We don't know by how much, and we are hoping to get some insight into whether or not the Fed is going to be raising them any more than the 3 times that we are already expecting this year. In the meantime, I wanted to take a look at the bond market. Now, real investment analyst Michael Lebowitz writes about the bonds and yields in today's post Fasten Your Seatbelt, Turbulence Ahead. Now, in it, Lebowitz shows how the yields for the 2, the 5, and the 10-year treasuries have been on a steady decline for more than 20 years. There are periods of increases, but you can see how this resistance line has actually been holding very steady. And when you combine all 3 securities, you can see that there have been 1, 2, 3, 4, now 5 periods where the yields have been climbing. The first was actually in the 80s. That was when higher interest rates were used to tame double-digit inflation, and it worked for a while. But when rates began to rise again, and in 1987, the 10-year Treasury actually climbed 3%. In 1994, the Feds began raising rates again. That actually caught investors off guard, and in 14 months, 2-year Treasury note yields jumped more than 4%. And so you see how this goes. So let's move back to today. We still have record low interest rates, but they are expected to go up starting today. And just like in the past, as you can see, the yields are hitting that upper resistance line. So what happens next? Well, Lebowitz says that there are actually 3 options. First, that this resistance is going to hold and that yields are going to start going south, and that would be most likely because of a drop in economic activity as investors start looking for safer investments. Second option is that yields could continue to climb. That would actually mean a lot more action on the bond market. Growth could suffer if these continue to climb too aggressively. And third, well, they may just meander on the resistance line for a while. This would actually be the best case scenario, suggesting that we have hit an equilibrium with moderate growth and mild inflation. Unfortunately, Lebowitz says that is the least likely scenario. The only thing that is for certain is that this year is going to be volatile. Bond and stock investors need to be ready for anything. Now, you can read more of Michael's article at realinvestmentadvice.com. You can take a closer look at all of these charts. He goes into a lot more detail than I could here. But that's it for me. Please remember to follow us on Facebook and Twitter. Subscribe to our YouTube page. I'm Mike O'Neill, and we'll see you again in a couple of hours.